Hello everyone, welcome to Dikshant classes. Today I am going to teach about the next branch of accounting is corporate accounting, under which I will discuss about the share capital. Share capital is a capital which is raised by a company against the share of a company, and it is issued to the shareholder of the company, and it includes shares and debentures. Next is meaning of a company. According to section 2, subsection 20 of the Companies Act 2013 defines a company. A company which is incorporated under this act means Companies Act 2013 or any other previous company law, which means Companies Act 1956. Next is definition of a company. A company is an artificial voluntary association of a persons created by law for carrying a lawful business and having separate legal entity from its member with a perpetual succession and common seal. It means that company is an artificial person and it is created by law and it is closed by law only, and it is a voluntary association of a person. It is not a compulsion of a person to create a business for carrying on a lawful business and having a separate legal entity from its members with perpetual succession and common seals. Company law is giving permission to the company for carrying on the lawful business, not an unlawful business, and it's separate from its members. And it's a company may go come and go. Person may come and go, but company never die, and it is die by the law only. And it's a common seal which is authenticate the authenticity of company. It is verifiable. It is authentic company. Next is features of joint stock company. First is incorporation. A company is formed under the provisions of the Companies Act 2013. Next feature is separate legal entity. Every company is separate from its members in the sense that it can raise money, enter into the contracts, and can sue and can be sued in its own name. Next is transferability of shares. The shareholder can transfer their shares in the name of others by selling them at the stock exchange with the help of stockbrokers. Next is common seal. All the documents are signed in the name of the companies, not in the name of any shareholder or directors. Next is perpetual succession. A company may come, the person may come and go. Person live and die, but company can run their business and run their operations forever until any notice of from a court to close down the business. The existence of company remain unaffected irrespective of the death, lunacy, and bankruptcy of its member. Even all the member dies, the company survive and law can create its law and liquidate it. Next is limited liability. The liability of the shareholder is limited to the unpaid amount of shares which is not paid by the shareholders to the company against the share issued, and no extra money can be demanded for them even in the case of liquidation. The next feature is separation of ownership from management. A company is managed by the director duly appointed by the shareholders in the annual general meeting of a company, are not authorized to intervene to the day-to-day activities. Next is types of joint stock companies. A joint stock company can be of two types: private limited company and public limited company. Private limited company is a company which is owned by the private persons, and public limited company is a company which is owned by the central government and the state government, or a mixture of semi-government. First, we'll discuss about the private limited company. As per section 2, subsection 68 of Companies Act 2013, a private company means a company having a minimum paid up capital of rupees 1 lakh or such higher paid up share capital as may be prescribed by its articles. And private company is restricted to transfer its right of transfer to its shares. And it is except in case of one person company, and other than a one person company it is restricted, and it limits the number of members to 200, and it prohibits to any invitations to the public to subscribe to any security of the company. Private company may be formed with minimum of 2 members. The name of the company must be the word private limited. Next is public limited company. According to the section 2, subsection 71 of the Companies Act 2013, public company means a company which is not a private company, which is owned by the central government and state government and has a minimum paid up capital of 5 lakh. And provided that company which is a subsidiary of a company, not being a private company. Public company may be formed with a minimum of 7 members, and there is no restriction on maximum number of members. The name of company must be and with the word limited. Next is share capital. The capital contributed by the owners of the shareholders is a joint stock company. It's called share capital. Generally in a company, the shareholders are the owners of the company, because they invest their money in the company. Capital of company divided into the parts or units of a fixed denomination, which is called shares. As per section 2, subsection 84 of the Companies Act 2013, share means the shares in the share capital of a company, including stocks. The capital of a company divided into parts or the unit of a fixed denomination. Every part is called share. As we know that capital of a joint stock company is divided into the small units which are known as shares, and each share carries a face value. Share capital refers to the company which raises the issuing shares at a given face value. It represented the total nominal value of the share issued by the company. In simple words, the amount contributed by the shareholder, which are owner of a company, they can invest their money in the company by subscribing to the company's shares towards the face value is called collectively share capital. Next is share capital can be classified into authorized share capital, which further classified in 2 parts. Issue capital, unissued capital. Issue capital, which is issued by part of the authorized capital and issued to the shareholders. Unissued capital, which is not issued by the company and reserved for future. Subscribed capital is a capital out of the issue capital. They are issued on the part of the issue capitals. Subscribed capitals and fully paid up. Subscribed capital out of the share capital or issued capital, they are subscribed and fully paid, for which the company call the amount of the fully amount of shares. Subscribed but not fully paid up. Subscribed capital is the capital the shareholders of the company is subscribed to its shares, but they are not fully paid up. Let us discuss in brief about the share capital. A company is an artificial person and whose management is done by as the constitutions of known as memorandum of association. It means that company is an artificial person and whose management is managed as per their constitution is known as memorandum of association. So the company's memorandum of association defines everything, including the maximum amount of that company can raise from its the general public where the issue of shares. The upper limit stated with the regards the share capital is called authorized capital. Authorized capital refers to the share capitals the joint stock company is registered. On the other hand, issue capital is a capital actually offered for the sale by the company to the general public. Authorized capital refers to the amount of capital which is the company registered itself with the registrar of company and is authorized to the issue by its memorandum of association. It means that the maximum amount of capital of the company through its member take power to issue during its lifetime. A statement of authorized capital needs to be made on the statutory form as well as registered with the registrar of company. The capital is divided into the shares whose denomination value determined by company promoter. The capital is not issued in full. That's all today's class. If you have any doubt, any query, you can put in the comment section. I will surely make videos. Thank you so much for listening carefully.